Well, I think Bitcoin's going to continue to grind up. I think the volatility is coming off of it as the industry becomes more structured with more derivatives and more ways to hedge it. Our expectation right now is end of the year, it should be about $150,000. And that's the consensus of the equity analysts that cover our company and the Bitcoin industry right now. I don't know why it won't grind up to $1 million a coin over the next 4 to 8 years.
Saylor's on-ramp is not just a headline. He frames the move as a function of maturing market structure and dampening volatility, which is a striking contrast to earlier boom and bust years. The $150,000 year-end waypoint serves as both a forecast and a signal to institutions that want clarity. The $1 million arc plants a longer horizon that makes near-term chop feel like noise. That is the tone for everything that follows.
Well, the news just came out today. S&P put out a press release that they've granted, for the first time to a Bitcoin Treasury company, a credit rating. So we were rated as a B-.
Is that fair?
It's a start. We expect to move up in the ratings over time, but we think it's a very auspicious start because it represents institutional adoption of Bitcoin-backed credit.
A credit rating sounds dry until you see the unlock. Many large pools of capital cannot touch unrated paper. A rating, even at the low end to start, flips that binary from no to yes. It is an invitation to conservative balance sheets that once stood on the sidelines. With one gate opened, the next gates tend to follow.
They buy things like Strife, which is a 10% dividend at par forever, like a 100-year bond or longer. And then for those that want extreme fixed income, they would buy Stride, because Stride is the junior credit instrument, but it yields about 12.5% effective yield, so about 350 basis points more than Strife.
The menu matters because not every investor wants raw spot exposure. Some want yield with duration, others want more upside with more risk, or short-term parking with limited volatility. By mapping credit products to risk appetites, Saylor is building on top of Bitcoin as base collateral. That structure widens the tent without forcing anyone into a single seat.
Yeah, well, the beauty of a digital credit instrument that's issued by a treasury company like ours is we fund the dividends by selling equity. And when you fund the dividends by selling equity, then the dividend becomes a return of capital. And as a return of capital, it means there is no tax on the dividend. So when you're getting 10%, you're getting 10% cash dividend yield. And what happens is your basis in the instrument is reduced by the cash dividend. So if you buy a $100 share and you get a $10 dividend a year, then your basis goes to 90, and then after the second year it goes to 80, and after the third year it goes to 70. But for the next 10 years, you have no tax. You don't pay qualified dividend, you don't pay long-term capital gains tax, you don't pay ordinary income. You just get a return of capital.
Tax engineering is not a sideshow. For many allocators, after-tax yield is the metric that decides mandates. By turning dividends into return of capital, he reframes the comparison with money markets and bonds. It is a pitch built for treasurers who think in net, not gross. It also shows how financial plumbing evolves when Bitcoin sits at the center.
I think the crypto industry has evolved over the past 12 months into two different sides. There's the digital capital side of the industry, and Bitcoin is digital capital, a long-term store of value, and digital credit instruments that are built on top of that capital. So we're accumulating the capital and we're selling the credit. On the other hand, there's digital finance. And the digital finance part of the industry is tokenized currencies, tokenized securities, tokenized brands. And that's all of the proof of stake networks and all the crypto exchanges and the stable coins and all the tokenized stocks and tokenized bonds and the meme coins. And that entire business is going through a Cambrian explosion of innovation as well.
This split clarifies why his forecast can sound bold yet grounded. Bitcoin as digital capital supplies the ballast. Digital finance provides the velocity. One side is the vault, the other is the marketplace. When both grow together, price targets stop looking like stunts and start reading like derivative outcomes of architecture.
Yeah, I think the most exciting thing is 12 months ago, you couldn't get a loan against Bitcoin or a loan against wrapped Bitcoin like an ETF like IBIT. You couldn't get those loans from any major bank in the nation. And now what you see is that Bank of America, JP Morgan, Wells Fargo, BNY Mellon are all beginning to embrace this asset class. You see other innovative banks, Charles Schwab, Texas Capital, they're offering pretty progressive credit terms against either IBIT, and now even many of those banks are starting to talk about offering credit against underlying Bitcoin.
Credit against Bitcoin is the keystone for mainstream leverage and liquidity. When household banks enter, policy is no longer theoretical. Custody, collateral, and credit lines form a triangle that pulls in corporates and high net worth clients. That bridge reduces friction for new flows. Forecasts then ride on pipes, not just vibes.
I think that this 12 months has been probably the best 12 months in the history of the industry, because what you got was the White House endorsing Bitcoin as digital gold. Then you got the SEC saying we expect that securities will be tokenized on chain and we're going to support it. You got the Secretary of the Treasury endorsing stablecoins and saying we believe that the future of the US dollar currency is to be tokenized and exported to the world, and we're going to support that. And now you've got a pro-crypto head of the CFTC. When you put that together with all the other cabinet members like RFK, like Tulsi Gabbard, like Howard Lutnick, et cetera, that are coming out with very pro-Bitcoin, pro-crypto initiatives, I just really don't think the industry could ask for much more.
Policy tailwinds do not set price by fiat, but they shape who can participate. Endorsements and clarity lower career risk for institutions. With that comes larger tickets and longer holding periods. Markets respond to the mix of buyers, not only to their beliefs. It helps explain why he sees volatility fading as structure improves.
I think it's, at this point, the industry is going to 10x. It's going to increase by a factor of 10 based upon activities that are taking place at JP Morgan, at Wells Fargo, at Bank of America, at Morgan Stanley, at BNY Mellon. It's the big household brands at Citi, right? They're the ones that are going to introduce Bitcoin and digital assets to the next billion people.
That is adoption as distribution. The forecast is anchored not in a single catalyst, but in a roster of banks that already serve the masses. Once those channels carry Bitcoin credit and custody, the top of the funnel widens. A rising base of owners can put a floor under drawdowns. Floors make targets more reachable.
So I think it's inevitable that you're going to see stable coins, especially US dollar-backed stable coins, that are going to explode from it was a $100 billion business a year ago to $250 billion to $500 to $1 trillion to $2 trillion. Eventually, I think there'll be $10 trillion worth of stable coin moving at the speed of light, millions of times a second. And I think that that'll be the medium of exchange in the digital economy.
Here he sketches the rails that run beside Bitcoin. If dollars move as stablecoins at machine speed, then the need for a durable store of value inside that system increases. One leg is spendable liquidity, the other is scarce collateral. Together, they describe an economy where Bitcoin is not a toy, but infrastructure.
And now that we've got an S&P credit rating, that's going to open up the market. There are hundreds of billions, if not trillions of dollars of capital that won't buy an unrated instrument. that can go ahead and acquire a rated credit instrument.
Looping back to the rating, you see the through line. Structure invites capital, capital builds products, products broaden access, access supports price. In that chain, year-end targets stop being hype. They become mile markers on a newly paved route. We have tracked his case from rating to product design, from banks to policy, and from stablecoin rails to Bitcoin as digital capital. The narrative is not a single bet, but a system of pipes, incentives, and participants that did not exist a few years ago. That is why a $150,000 year-end call feels shocking and, to him, inevitable. One last line captures the horizon he is steering toward.
And of course, my long-term forecast is it goes up about 30% a year for the next 20 years, and we're headed toward $20 million Bitcoin.
Do you buy the roadmap he lays out, or do you think one link in that chain breaks before we get to his year-end target?